So, the July meeting, it's still going to be a debate, I think, about 50 or 75. We still have a couple weeks to go to look at the data. If conditions were exactly the way they were today, going into that meeting, like if the meeting were today, I would be advocating 75 because I haven't seen the kind of numbers on the inflation side that I need to see in order to, think that we can go back to a 50 increase. So I think right now I would be advocating 75, but again, we don't have to make that decision today. We still have a couple weeks to go. I think getting interest rates up to that 3 to 3.5% is really important that we do that and do it expeditiously and do it consistently as we go forward. So it's after that point where I think there's more uncertainty about how far we'll need to go in order to rein in inflation.
Yeah, I mean, there's some parts of the markets are already speculating that you actually have to cut rates again early next year. Would you say that's exaggerated?
Well, I don't see that in my baseline, but again, we're going to just have to assess economic conditions on the ground as we go forward. Again, it's really about what's the speed at which demand is moderating, what's the speed at which perhaps some of the supply constraints are easing, and it's that balance between the two that we need to get to so that price pressures get reined in and get back to a more normal inflation rate.
What are the implications for the real estate markets? Because we have seen mortgage applications also slumping, and it's so important also for the U.S. consumer.
Well, one of the mechanisms when we raise interest rates is we do expect to see some slowdown in those very interest rate sensitive sectors, and housing, of course, is one of those. The housing market has been extremely strong. Mortgage rates have been low, but as we've begun to tighten rates, you're right, mortgage rates have gone up, and we're starting to see some slowdown there. But again, we're looking for some moderation in those sectors in order to relieve price pressures.
Where do you see actually the worst bubbles perhaps in the economy which could be affected by the rate hiking cycle?
Well, the markets have moved, and the volatility in the markets probably is here to stay. Certain days, it's moving up. Certain days, it's moving down. But again, I think what's important is that we're on a path of bringing our interest rate up to a more normal level, and that's the mechanism through which we're going to do what we can on our side to moderate demand. Again, lots of other things are affecting inflation now that are beyond our control, but we have to do our part.
You've said earlier in our interview that you have not seen inflation moderating, of course. Where do you see peak inflation and when, perhaps?
Yeah, well, I do expect inflation to moderate a bit, but we haven't seen those numbers. So I need to see consistent, monthly changes that are first stabilizing and then moving back down, and we haven't really seen that yet. So I think inflation from here could go up a little bit from where we are, but I do expect that our interest rate policy, as we move that path of interest rates, continue on that upward path, inflation will moderate. I don't think it'll be near 2%, certainly this year, and probably moving down over the second half of next year to still being above 2% by the end of the year, but well on its way.
Yeah, the ECB is expecting inflation to be back to target in 2024. What are you expecting for the U.S. economy?
Yeah, I think we'll be well on our way next year. So I think in my SAP, I penned in like a 2.5 to 2.75% by the end of next year. But really, that's good in the sense that it'll be obvious that inflation is moving back down, and then also I have inflation then taking after that, the year after that, to come back to 2%. So again, it is a process. We're just at the beginning of the rate rises, really, but we've got to be consistent and intentional in order to rein in those price pressures and get inflation back down towards our goal.